Most Americans think mutual funds, index funds, ETFs, and hedge funds are all the same thing. They are not. Understanding the difference could save you thousands of dollars in fees and help you retire years earlier. If you have ever opened a retirement account or tried to invest for the first time, you have probably seen these terms thrown around like everyone already knows what they mean. Mutual funds, index funds, ETFs, and hedge funds. They all sound like fancy Wall Street words that only rich people understand. But here's the truth. These are just different ways to pool money together and invest it. The problem is that most people do not know which one is right for them. They pick the wrong one. They pay too much in fees. They lose money without even realizing it. And years later, they wonder why their retirement account is not growing the way they expected. Today, we're going to break down each of these investment types in plain English. No jargon, no confusion. Just real talk about where your money goes, how much it costs, and which option actually makes sense for regular people trying to build wealth. A mutual fund is a pool of money collected from thousands of investors and managed by a professional fund manager. That manager picks individual stocks and bonds they think will perform well. The idea sounds great at first. You give your money to an expert, they do all the work, you sit back and watch your account grow. This is why most Americans with a 401k or IRA end up in mutual funds without even knowing it. But here's the problem most people miss. That fund manager charges you a fee every single year, whether they make you money or not. This fee is called the expense ratio. It usually ranges from 0.5% to 2% annually. That might sound small, but it adds up fast. If you invest $10,000 and pay a 1% fee every year for 30 years, you will lose over $60,000 just in fees. Most people never see this number because it gets taken out quietly in the background. On top of that, mutual funds often come with something called a load fee. This is a sales charge you pay just to buy into the fund. It can be as high as 5% up front. So if you invest $10,000 with a 5% front load, only $9,500 actually gets invested. The rest goes to the person who sold you the fund. And here's the kicker. Most mutual fund managers don't even beat the market. Studies show that over 80% of actively managed mutual funds fail to outperform a simple index fund over 10 years. You're paying high fees for average or below average results. A real example. Imagine Sarah just started her first job and her employer offers a 401k with 10 mutual fund options. She picks one with a 1.2% expense ratio because it has a fancy name and strong past performance. She does not realize that past performance means nothing for future results. Over 20 years, that extra fee will cost her tens of thousands compared to a low-cost option. She trusted the system without understanding how it really worked. An index fund is also a type of mutual fund, but with one huge difference. It does not try to beat the market. It tries to match the market. An index fund tracks a specific market index, like the S&P 500, which represents the 500 largest companies in America. Instead of paying a fund manager to pick stocks, the index fund just buys all 500 companies in the same proportion as the index. No guessing, no stock picking, no expensive manager. This is called passive investing. Because there's no active management, the fees are incredibly low. Most index funds charge between 0.03% and 0.2% per year. That's up to 20 times cheaper than an active mutual fund. Over decades, that difference turns into hundreds of thousands of dollars staying in your account instead of going to Wall Street. The other massive benefit is performance. Since most active managers fail to beat the market, an index fund that simply matches the market will outperform most mutual funds over time. Warren Buffett, one of the greatest investors in history, recommends index funds for regular people. He even put his own family trust money into index funds. If a billionaire investor says this is the smartest move, it's worth listening. Index funds also remove emotional decision-making. You're not betting on a manager's skill or trying to time the market. You're buying the entire market and holding it for the long term. That's how real wealth gets built. A real example. John is 30 years old and opens a Roth IRA. He puts $6,000 per year into a low-cost S&P 500 index fund with a 0.04% expense ratio. He does this every year until he is 65. Assuming 7% average annual returns, he will have over $1.3 million. If he had picked a mutual fund with a 1% fee instead, he would end up with around $900,000. Same contributions, same market returns, but $400,000 less just because of fees. An ETF stands for Exchange Traded Fund. It's very similar to an index fund in structure and strategy. Most ETFs are passively managed and track an index, just like index funds do. The biggest difference is how you buy and sell them. Mutual funds and index funds are priced once per day after the market closes. You submit your order, and it gets filled at the end of the day price. ETFs trade on the stock market throughout the day, just like individual stocks. You can buy or sell them anytime the market is open. This gives you more flexibility and control. If you want to buy at 10 a.m. or sell at 2 p.m., you can. With a mutual fund, you have to wait until the end of the day. Another advantage is cost. ETFs often have even lower expense ratios than index funds. Some popular ETFs charge as low as 0.03% per year. They also don't have minimum investment requirements like many mutual funds do. You can buy a single share of an ETF for as little as $50 depending on the price. This makes them accessible for beginners or people investing small amounts. However, there's one small catch. Because ETFs trade like stocks, you might pay a small commission to your broker each time you buy or sell. Many brokers now offer commission-free ETF trading, but it's something to check. ETFs are also slightly more tax efficient than mutual funds due to how they're structured, but for most regular investors, this difference is minor. The real question is this: should you pick an index fund or an ETF? Honestly, for most people, it doesn't matter much. Both are low cost, both are passive, both will help you build wealth over time. If you're investing through a 401k, you'll probably use index funds because that's what most employers offer. If you're investing through a brokerage account on your own, ETFs might be easier and cheaper. Either way, you're making a smart choice. A real example. Maria wants to invest $500 per month but doesn't have a 401k. She opens a brokerage account and buys shares of a total stock market ETF every month. The expense ratio is 0.03% and there are no commissions. Over time, her account grows steadily because she's not paying high fees and she's invested in the entire market. She never has to worry about picking the right stocks or timing the market. She just keeps buying and holding. A hedge fund is a private investment fund that uses aggressive strategies to try to generate high returns. Unlike mutual funds, index funds, and ETFs, hedge funds are not available to regular people. They're only open to accredited investors, which means you need to have at least $1 million in net worth excluding your home, or earn at least $200,000 per year. This is a legal requirement set by the government. The idea behind hedge funds is that they can make money in any market condition. They use strategies like short selling, leverage, derivatives, and other complex tools that most people don't understand. The managers are often considered the smartest people in finance. They charge enormous fees. The standard fee structure is called 2 and 20. That means they charge 2% of your total investment every year, plus 20% of any profits. So if your hedge fund makes 10% in a year, you pay 2% just for having your money there, plus 20% of the profit. That's a massive cut. And here's the dirty secret. Most hedge funds don't even beat the stock market. Studies show that after fees, the average hedge fund underperforms a simple S&P 500 index fund. You're paying the highest fees in the industry for worse results than you could get for almost free. Hedge funds also lock up your money. You can't just pull it out whenever you want. Some require you to keep your money in for years. If you need cash for an emergency, too bad, it's stuck. So why do rich people invest in them? Honestly, a lot of it is status and access. Hedge funds are exclusive. They make you feel like you're part of an elite club. But the math doesn't lie. For building long-term wealth, hedge funds are a terrible deal for almost everyone. A real example. Imagine a billionaire invests $10 million into a hedge fund. The fund makes 10% that year, so the account grows to $11 million. Sounds great, right? But then the fees hit. 2% of $10 million is $200,000. 20% of the $1 million profit is another $200,000. So the investor actually only keeps $600,000 of the $1 million in gains. Meanwhile, if that same billionaire had just put the money in an S&P 500 index fund and it returned 10%, they would keep almost all of it after paying a tiny 0.03% fee. The hedge fund manager made $400,000. The investor got a worse result than they could have gotten for free. Most people do not realize how much fees actually cost them over a lifetime. A 1% difference in fees might not sound like a big deal in 1 year, but when you invest for 30 or 40 years, that small percentage becomes life-changing money. Let us say you invest $500 per month for 30 years. The stock market averages about 7% returns per year after inflation. If you pay a 1% fee every year in a mutual fund, your account will grow to about $570,000. If you pay a 0.1% fee in an index fund or ETF, your account will grow to about $660,000. That's a $90,000 difference just from fees. You did not work any less hard. You did not take any less risk. You just picked a lower cost option. Now imagine you're investing for 40 years instead of 30. That same fee difference turns into over $200,000. That could be the difference between retiring comfortably at 65 or having to work until 70. It could be the difference between leaving your kids a nest egg or leaving them nothing. Fees are silent killers. They do not feel painful in the moment because they're taken out automatically. You never see the money leave your account. But over time, they compound against you, just like interest compounds for you. Wall Street loves this because most people never do the math. They see their account grow a little bit each year and think everything is fine. They do not realize they could have twice as much if they had just paid attention to fees. A real example. 2 coworkers, Tom and Lisa, both start investing at age 25. They both contribute the same amount every month. Tom picks a mutual fund with a 1.2% fee because his financial advisor recommended it. Lisa picks a low-cost index fund with a 0.05% fee. 40 years later, Tom has $1.1 million. Lisa has $1.8 million. Same job, same contributions, but Lisa has $700,000 more just because she avoided high fees. That's enough to completely change her retirement lifestyle. Here's something most people don't know. Many financial advisors get paid commissions to sell you certain mutual funds. They are not legally required to act in your best interest. They only have to recommend something that is suitable, which is a much lower standard. This means they can sell you a high-fee mutual fund that earns them a big commission, even if a low-cost index fund would be better for you. They're not lying, they're just following the incentive structure. If a mutual fund company pays them a 5% commission on every dollar you invest, and an index fund pays them nothing, which one do you think they will recommend? This is called a conflict of interest. The advisor benefits when you pick the expensive option. You lose money, but they win. Not all advisors work this way. Fee-only advisors charge you a flat fee or hourly rate and do not earn commissions. These advisors are legally required to act as fiduciaries, which means they have to put your interests first. If you're going to work with a financial advisor, always ask how they get paid. If they say commissions, or if they avoid the question, walk away. A good advisor will be upfront and transparent. A real example. Jake meets with a financial advisor who seems friendly and knowledgeable. The advisor recommends a mutual fund with great past performance and a 1.5% expense ratio. Jake does not ask about fees or commissions, he just trusts the expert. What Jake does not know is that the advisor is getting paid a 4% commission up front, plus a small ongoing fee every year Jake stays invested. The advisor is not a bad person, they're just doing their job. But Jake is the one who loses because he's paying high fees that will cost him hundreds of thousands over his lifetime. If Jake had asked the right questions or done his own research, he could have avoided this entirely. If you take nothing else from this video, remember this. Low-cost, broadly diversified passive index funds, or ETFs, held for the long term will beat almost every other strategy for regular people. You do not need to pick individual stocks, you do not need to pay a fund manager, you do not need a financial advisor unless you have a complex situation. You just need to buy the whole market, keep your fees as low as possible, and let time do the work. This is not sexy, it's not exciting, you won't have stories to tell at parties about the stock you picked that doubled, but you will have something better. You will have wealth. Real, lasting, compounding wealth that gives you freedom. The strategy is simple. Open a brokerage account or retirement account. Choose a low-cost total stock market index fund or ETF, or an S&P 500 index fund or ETF. Invest a fixed amount every single month no matter what the market is doing. Never sell. Just keep buying. Do this for decades. That's it. No tricks, no secrets, no complicated moves. The math works because you're capturing the growth of the entire economy over time. American companies grow, they innovate, they make profits. You own a piece of all of them. And because your fees are near zero, almost all of that growth stays in your account. A real example. Emma is 28 and just learned about index fund investing. She opens a Roth IRA and sets up an automatic monthly investment of $400 into a total stock market index fund. She doesn't watch the news, she doesn't check her account every day, she just lets it run. By age 65, assuming average market returns, she will have over $2 million. She never picked a single stock, she never paid high fees, she just stayed consistent and let compound interest work its magic. That's the power of simplicity. Here's what you need to remember. Mutual funds are expensive and most of them underperform the market. Index funds are cheap, simple, and they match the market, which beats most active funds over time. ETFs are almost identical to index funds, but trade like stocks and often have even lower fees. Hedge funds are for the ultra-wealthy, charge insane fees, and usually deliver worse results than a basic index fund. The biggest mistake you can make is paying high fees without realizing it. The second biggest mistake is overthinking this and doing nothing. You do not need to be a genius to build wealth. You just need to start, stay consistent, and keep your costs low. Pick a low-cost index fund or ETF. Invest regularly, hold forever. That's the strategy that works. Money doesn't have to be complicated, and investing doesn't have to be scary. The financial industry wants you to think you need experts and expensive products, but the truth is simpler and cheaper than they'll ever admit. If you found this video helpful, make sure to like the video, subscribe to the channel, and share it with someone who needs to hear this today.